Last week, the US stock market asserted its strength despite stubborn inflation, the hawkish rhetoric of central banks, recession fears, and the Fed's bank stress test. The high-tech sector was the catalyst for the rally on Wall Street, and the results of the first half of 2023 gave food for thought. Wall Street is opening a new quarter with a sweeter aftertaste. This week will be shorter than usual, and the benchmark stock indexes closed last week with confident gains. The Dow Jones climbed by 285 points, or 0.48%. The Nasdaq showed the strongest performance with a 1.45% gain. The S&P 500 rose by 53 points, or 1.23%, to close at 4,450 points. The pre-market promises cautions optimism during the New York session today. The benchmark indexes traded mixed before the opening bell, making a retracement after the market boost on the final day of the half of a year. The S&P 500 is expected to trade in the intraday corridor between 4,440 and 4,470 points. The major stock indexes extended their growth on a Friday, and notably the Nasdaq looked the strongest growth in the last 40 years. The index jumped by 31.7% in the first 6 months of the year. It's the best result in the whole history of the market survey. Something more showed a brilliant performance. Apple topped the landmark market value of $3 trillion for the first time since January 2022. Its shares closed 2.3% up at $193.97 apiece, after having perked at $194.48. Apple's share price is up 49% this year, pushing the company's weight in the S&P 500 to 7.6%, the most of any stock in the index history. Such a significant weight means that the dynamic of Apple shares has a huge impact on the performance of the index. Apple's weight in the S&P 500, for example, is greater than that of the entire 37-stock consumer goods sector, which was the smallest in terms of a share at 6.7%. The US CPI that proved easing inflationary pressures contributed to the successful completion of the quarter and the 6 months. The US Commerce Department reported the personal consumer spending index rose by 3.8% from a 4.3% in April. Excluding volatile food and energy, the core PCE grew by 0.3% from a 0.4% in the previous months. Complementing previous statistics, personal consumption spending bolstered hopes that the Fed is moving closer to the end of its rate hike cycle. Of course, the indicator is far from the target level of 2%, but on the other hand, the overall picture is in such a way that the chances of the Fed to tame inflation and not drive the country into recession are growing. In this context, all 11 S&P 500 industry sectors ended trading in the green zone. The technology segment led the way with a 1.8% growth. The largest gains in the S&P 500 came from Apple, Microsoft, Nvidia, Amazon, and Meta, and they added from a 1.6% to 3.6%. For the week, the S&P 500 gained 2.35% and the Nasdaq rose by 2.20%, and the Dow increased by 2.02%. For the quarter, the S&P 500 gained 8.3%, the Nasdaq surged by 12.8%, and the Dow rose by 3.4%. The S&P 500, despite fears of a recession and the banking crisis in the United States, increased by 15.9% in the first half. The Russell Small Cap Index closed 0.4% higher, posting its fifth straight day of gains. On Monday, the euphoria on Wall Street began to cool down, along with a pullback from Apple, Microsoft and Meta, given that Tuesday is a U.S. Independence Day holiday. Stocks will close early today and trading volume will be thin. Despite the holiday, the market promises to be volatile. Investors are yet to evaluate the minutes of the latest Federal Reserve policy meeting on Wednesday, and now the market estimates an 84% chance of another rate hike in July. Still, a new portion of economic data may shed more clarity on the Fed's plans. In addition, this week the focus will be on the U.S. labor market. First of all, the non-farm payrolls will be available on a Friday, and the report, which will give investors an idea of the state of affairs in the economy after the Fed's rate hike. Signs of a steady, strong employment growth could reinforce the view that the U.S. economy can avoid a major recession despite the Fed's tightening, but also spur estimates of a further tightening. Today, market sentiment may be affected by the latest manufacturing PMI for June, which is expected to reflect expansion in the sector. In the corporate world, electric car maker Tesla promises to be the star of the day. The company's shares added 6.1% before the opening bell, but later cut earnings slightly. Tesla's shares were boosted by news that second quarter deliveries outperformed market estimates thanks to stimulus and increased rebates. Deliveries in the second quarter increased to a record 83% from a year ago and 10% compared to the first quarter. Among other drivers, Apple's stock fell 0.2% after a rapid rally last week that helped the world's most valuable company surpass a $3 trillion market cap. Microsoft shares also lost 0.2% in the pre-market. US-listed shares of a Chinese automaker Xpeng jumped by 10.8%. after reporting that its second quarter shipments were up 27% from the first quarter. Carnival stock jumped by 9.7% after Jefferies upgraded the cruise operator stock to buy from a hold. The currency market is trading quietly today. The US dollar index has been trading higher above 103 for most of the day. It lost some steam in the pre-market and the index was trading at about 102.90 points at the time of recording this video. The intraday candle for the instrument is seen between 102.70 and 103.20 points. The dollar index on Monday was trying to recover after falling by 0.4% on Friday. Despite the support of the Fed speakers led by Powell, the dollar index could not resist the pressure of the macroeconomic data. The past week has painted a picture of the resilience of the US economy and waning recession fears. Data on a Friday showed lower than expected inflation in May, while consumer spending shrank sharply, suggesting that the Fed's rate hikes are having the desired effect. Given that in almost all hawkish statements, Fed's policymakers referred to the economic data and the picture of further tightening seems ambiguous, markets estimate the likelihood of a 25 basis point rate hike at the July meeting with a probability of 84%. The final point of the cycle is rather blurry. Against this background, the dollar is unlikely to gain momentum before the publication of the minutes of the Fed's policy meeting in June. The document will provide more clarity on the arguments that led to the Fed's pause and to assess the likelihood of a 50 basis point hike before the year end. Importantly, the first half of the year was not so bad. for the dollar index. Although it was not a record one, the index is up 2% in the first 6 months of 2023, and the fall of the yen against the US dollar by 9% this year worsened on a Monday. The yen tumbled to almost an 8-month low in the face of interventions. Japan's finance minister said on Friday that Japan would take appropriate steps in response to the excessive weakening of the yen. Meanwhile, the Canadian market has shut for the public holiday, Canada Day, and the loonie is not in the festive mood. Having grown by 0.12%, the USD CAD pair is trading at 1.3250 within the intraday Canada between 1.3230 and 1.3280. Despite slight intraday weakening, the loonie continues to be fueled by strong macroeconomic data and faith in a rate hike by the Bank of Canada. Canada's economy regained momentum in May after contraction in April. A preliminary estimate for May, which may change after the release of the final data, suggests that real GDP is likely to have increased by 0.4% due to the expansion in the manufacturing and the wholesale trade sectors. Real estate is also picking up steam, while the decline is expected in mining, quarrying, oil and gas. While April's growth fell short of expectations, the strong outlook for May is consistent with the signs that the economy remains robust despite the Bank of Canada's record-breaking monetary tightening cycle. Early in June, the central bank raised its key interest rate to a 22-year high of 4.75% on concerns that inflation could be stuck above its 2% target level. Most analysts expect another 25 basis point rate hike either next month or in September. As for the oil market, which supports the loonie, oil prices rose on a Monday after top exporters Saudi Arabia and Russia announced supply cuts in August, eclipsing fears of a global economic slowdown. Brent crude futures edged up by 0.2% to $75.54 a barrel, and US WTI also rose by 0.2% to $70.77. The crypto market is trading mixed. Bitcoin was poised to open the week with gains, but moderated its optimism in the pre-market. Having grown by 0.3%, the crypto is trading at $30,680. Popular altcoins traded mixed in the pre-market. Ether looked the most growth, having gained 2.6%. Other top tokens shed from a 0.4 to 1.2%. The Bitcoin ETF frenzy continues to be in the spotlight. So does the standoff between exchanges and regulators. The US Securities and Exchange Commission has required exchanges to provide details of the joint oversight agreement with a particular Bitcoin exchange or to provide sufficient information about the agreement. It's cooling down the hype, having pushed Bitcoin down by 3% instantly. Portfolio managers reacted to the regulator's stance with an intervention to reapply for Bitcoin ETF. Specifically, CBOE intends to enter into a joint oversight agreement with the Coinbase, given the position of issuers and the rather rapid recovery of Bitcoin after the fall. Digital gold may continue to grow. At the same time, historically, the third quarter has always been the weakest for Bitcoin. Average growth has been just 4.67% since 2014, with the only 4 out of 9 third quarters seeing positive growth. As the macroeconomic and sectoral factors continue to intersect, a similar calm period could follow in the next 3 months. Currently, Bitcoin is trading steadily inside the range of $29,700 and $30,800, and the crypto can trade in a narrow range between $30,600 and $30,800, provided that there are no shocks. Going beyond the borders of the range can lead the price to a height of $31,400, and the alternative scenario looks like a decline below $30,000. That's all for today. We keep monitoring the financial market situation. Subscribe to our channel and see you online tomorrow.